At the US Exim Bank's annual conference in Washington, D.C., delegates spoke of the importance of export credit agencies in the growth of the export finance market. But ECAs, they warned, will only ever complement and not compete with commercial banks.
Over the last couple of years, there's been a lot of growth in the export finance industry, and this has really been the result of ECAs stepping up to the table to bring liquidity to market at competitive pricing.
According to market data, in 2012, export credit agencies have essentially supported 1/3 of the total project finance business, 1/3 of the total aircraft financing business, and 1/3 of the total shipping finance business. Clearly, the export credit agencies have been a very, very important complement. As the market goes back to normal, we are expecting the agencies to retreat a little bit from that.
Generally speaking, a lot of what we do are larger loans that are made on a domestic basis to our borrowers, where there's a smaller export component. So we layer on an Exim-backed loan on top of an existing loan or a new loan for a new customer, but they're working together to promote the company's business. It's not competing at all. It just lets us offer that much more money for the growth of our borrowers.
Warm praise was reserved for the flexibility ECAs showed during and after the financial crisis.
The agencies, I think, in general have been quite effective in adapting their business model to a new environment. The traditional collaboration between agencies and banks, which was essentially based on the agencies providing guarantees and credit enhancements and banks providing funding, over the last few years as a result of the liquidity issues of the banking sector have changed, and banks and export credit agencies have been more active as direct lenders.
But if US Exim is to stay competitive with other agencies, some are saying it needs to reduce the minimum US content requirement on transactions it will cover.
Some ECAs, for example, EDC and Finvera, they look more at the contract being of national interest to the country of the exporter. And this, of course, becomes very challenging when some ECAs are still requiring that a certain percentage of exports are identified as being coming from a specific country.
The question is on long-term debt and mid-term debt, whether or not the American content requirement for 85%, which was adjusted in 1987 from 100 to 85%, needs to be adjusted again in order to create additional growth in American jobs now. And the debate rages on both sides that if you lower the content, you increase the supply chain demand, which allows foreign nationals to have parts of our export base, which doesn't create U.S. jobs and allows them into markets they wouldn't normally be in. Labor complains that if we do that, then we won't be able to support developing U.S. jobs. So and commercial people said, give me every advantage, because any requirement of holding back is a requirement too much. And so everybody I've talked to in commerce or in business says, let's lower it to zero.